Right friends, we are going to start a new series on banking awareness. We will have around 4 types. First and the foremost is the lecture part. You may have around 30 lectures on banking awareness. They will be followed by question and answer sessions. The third series will be true false. That means sentences will be given. You are required to assess whether the sentence is correct or incorrect. The fourth series will be on abbreviations. So, we are going to discuss the entire syllabus of banking awareness in 4 formats. We are going to discuss the entire syllabus of banking awareness in 4 formats. The first and the foremost format is lecture part. We are going to discuss various aspects in detail. The second format will be question and answer session. Third one will be identifying the correct or incorrect sentences. Fourth one will be explaining various acronyms and abbreviations with detailed explanation. This way we are starting this banking awareness series. This is exclusively required for the persons who appear for various banking service examinations. Not only that, for other examinations also it may be useful because it is a part of economy. Banking is after all a part of economy, important part of economy, and I would like to explain all the salient points pertaining to each and every aspect of banking awareness. Right, this is the first lecture, and initial lectures on this banking awareness starts from fundamentals, and initial modules are divided into a snapshot on banking operations. A snapshot on banking operations, that means primary aspects with regard to the working of various banks are divided into various parts, and this lecture is part 1 of this snapshot on banking operations. Right, let us look at the important issue, how the banks function. How the banks function, how they will get profit, all these things we are going to discuss in this first part. So, let us look at the first and the foremost part. Please look into this chart, and here a vertical line is given. Here a vertical line is given. That vertical line, basically it is interest percentage. Basically it is interest percentage. When you go to bank, there are primarily 2 things. One, either you are going to deposit money, or you are going to the bank to take some loan. We go to bank for 2 reasons. One is to deposit money. Second is to take loan from bank. So, when we deposit money in the banking system, they are required to pay us interest. When we deposit money in the banking system, they are required to pay us interest. This vertical line you are seeing in the picture is basically the interest rate. Here, if you look at current account deposits, the interest rate will be 0. Don't confuse at this juncture what is current account, what is a savings account. These things we are going to discuss in module 2. But I would like to explain this vertical line pertaining to the detailed operations of banking or how the banks function. In this vertical line, no interest is paid on current account deposits. The second one is the savings account deposits. Some interest is paid, around 4%. Next comes fixed deposit accounts and recurring deposit accounts, fixed deposit accounts and recurring deposit accounts. Then one more category is their bulk deposits. Bank deposits primarily constitutes these 5 types in general. And when we deposit money with the bank, they are required to pay interest to us. When we deposit money with the banking system, they are required to pay us interest. And that interest varies. The interest which they pay vary depending on the deposit. If the deposit is current account, banks need not pay any interest. If the deposit is of a bulk deposit or a fixed deposit, they have to pay more interest. For savings deposit accounts, they are paying around 4%. So, whatever the way we deposit money with the bank, they are required to pay us interest except current account. As banks are required to pay us interest, the deposits with the banks are known as liabilities. As banks are required to pay interest, deposits with the banks are known as liabilities. What is liability? What is asset? You have a friend who always gives you money. He is your asset. You have a friend who always gives you money, who always helps you. He is your asset. Look at the other scenario. You have a friend who always asks you money. You have a friend who always asks you money. He will be your liability. Similarly, when we deposit money with the banking system, they are required to pay us interest. That's why the deposits are called liabilities for banks. The deposits are called liabilities for the banks, and banks are required to pay us interest, and the average interest of all these deposits put together is known as cost of funds for banks. Average interest required to be paid across all these types of deposits is known as cost of funds for banks. Cost of funds for banks is nothing but average interest rate which they are required to pay to the customers. Let me reiterate once again, all the deposits for banks are liabilities, and the average interest rate which they are paying is known as cost of funds. So, having learnt this, cost of funds for banking system should be as low as possible. Cost of funds for banking system should be as low as possible. How to reduce cost of funds now? The second important point is how to reduce cost of funds. Cost of funds can be reduced if banks have more current account and savings account deposits. Cost of funds can be reduced if banks have more current account and savings account deposits, because on current accounts banks are not required to pay any interest. Savings account, the interest rate is very less, it is around 4%. But if banks have more fixed deposits, their cost of funds will be more. If banks have more fixed deposits, their cost of funds will be more. That's why in the banking system, banks require more current account and savings account deposits. But the problem here is current account, savings account deposits can be withdrawn at any point of time. They are unstable deposits. Today he may deposit 10 crores. Tomorrow he may withdraw all the 10 crores. That's why they are unstable deposits and volatile deposits. But fixed deposits, they are for fixed term. Banks can plan their activities. Fixed deposits are for fixed term. Banks can plan their activities. So, the advantage of having more fixed deposits is the deposits are stable banks can plan their loans. Let me reiterate once again. The advantage of having more current account and savings account deposit is their cost of funds will be less. But the disadvantage is they are volatile. They may be taken out at any time. The advantage of having more fixed deposits is banks can plan for loans. Banks can plan their activities. But the disadvantage of having more fixed deposits is their cost of funds will increase. So each one has got its own advantages and disadvantages. That's why banks should have judicious mix of both the deposits. Bank should have judicious mix of both the deposits. So for the time being, please do not forget, cost of funds for banks should be as less as possible. Let us look at this picture. This vertical line is interest percentage on loans. First part we have seen. When we deposit money with the banking system, they are required to pay us interest, which is known as cost of funds for banks. The second part now we are looking at. When you are depositing money with the banking system, there are two only. One is deposit, the second one is loan. There may be several types. Now we are looking at loans. There are several types of loans. House loans, mortgage loans, corporate loans, personal loans. We will discuss the salient features of these loans in subsequent modules. But for the time being, we are concentrating on the methodology of the bank operations. For the time being, we are concentrating on the methodology of banking system, and here this vertical line shows the various interest rates. Right, the second point here is, when banks are giving loans to us, we pay interest to the banks. We pay interest to the banks. That's why they are assets for the banking system. We are paying interest to the banks. That's why they are assets to the banking system. And the income which they are getting is known as yield or income. The income what the banks are getting is known as yield or income. First one is cost of funds. Second one is yield or income. Yield is nothing but the average interest which they get on loans is known as yield or income. Right? Yield or income should be as high as possible. Yield or income. Yield or income is nothing but the average interest which they get on loans is yield or income. Yield or income should be as high as possible. But because of the competition between various banks, they cannot increase the interest rates on loans. If one bank increases, customers will go to second bank. That's why banks cannot increase the interest loans. Their difference is hardly 0.25% or 0.5%. That's why banks cannot do much as far as this portfolio is concerned, that is loans. So, yield or income is nothing but average interest they get on various loans. Banks are one side, have to pay us interest on deposits, that is cost of funds. The other side they will get interest on loans, that is yield. So the gap between these two, that is average interest or cost of funds and yield, the gap between these two, that is between yield and cost of funds, should be minimum 3%, which is known as net interest margin. Net interest margin is the margin between yield and cost of funds. With this gap between yield and cost of funds, banks have to pay salaries, banks have to pay rent on their premises, banks have to pay for their operations, and they have to get profit also. For example, I have taken average cost of funds as 6.8%. Average cost of funds as 6.8%, whereas average yield on advances I have taken 9.8%. The gap here is 3%. This is viable banking operation. Banks require this net interest margin of 3% to ensure profitability. Banks require at least this 3% gap. I will tell you an example by taking some deposits. Let us assume banks have got 100 crores of money. Banks have got 100 crores. Let us assume cost of funds is 6%. That means they have to pay 6 crores per annum. If the yield is 9%, they will get 9 crores per annum. That means the difference 3 crores is the income which they get on 100 crores. If the net interest margin is 3%, they will get 3 crores for every 100 crores of deposits. If the net interest margin is 3%, they will get 3 crores for every 100 crores of deposits. And they have to meet all the expenses within these 3 crores and have to ensure profitability with this gap only. Right? We have looked at it that 3% is required for profitable banking operations, and look at this chart, the difference between this average cost of funds and average yield is 2.5%, which is not sufficient for ensuring profitability. Case 1 we have already discussed. Case 1 is met by State Bank of India, ICICI Bank, HDFC Bank, Axis Bank. For all these banks, the net interest margin is either 3% or more. But when you look at the small banks like Andhra Bank, United Bank of India, State Bank of Mysore, if you look at such type of smaller banks, the net interest margin is less than 3%, around 2.5%. Right? Let us summarize what we have learned in this class. One is net interest margin, or the difference between yield and cost of funds, which is known as net interest margin, is the important parameter in deciding the profitability of banks. In deciding the profitability of banks. And second important point is most of the public sector banks do not have the required net interest margin, and they are not able to ensure required profitability as their net interest margin is much less than 3%. Smaller public sector banks are unable to attract current accounts. That is the main reason why their net interest margin is less than 3%. State Bank of India, ICICI, HDFC, Axis Bank, they are able to maintain net interest margin of more than 3%, but smaller public sector banks are unable to maintain net interest margin of this 3%. That's why they are not able to achieve the desired profitability. So, in the first lecture, we learnt in detail about what is cost of funds, what is yield, and what is net interest margin. Right, friends? In the second lecture, we are going to discuss about various types of accounts. Right? Have a nice day. Thank you.